a new venture debt fund that's called ValuAble, and they are in fundraising efforts to seeking to secure close to a little over $100 million to invest in technology-driven and inclusive startups in India and across the globe. Rahul Gupta is the founder and managing partner, now joining in from ValuAble. Rahul, good to have you on board. Thanks so much for joining in. So tell us a little bit more about this fundraise plan, what's in place, and what kind of companies you're looking to invest in. Are they primarily going to be tech-driven?
ValuAble has embarked on its first journey, and 850 crore is the first fund that we are raising. The thesis behind the fund is simple. We are ESG aligned first venture debt fund in India. What that means is we are going to stay away from the sin sectors like alcohol, gambling, tobacco. What we focus on is scale, return, and on sustainable spaces. And the three pillars that form the foundation of our investment thesis will be climate, second is going to be inclusion, and third is going to be Bharat. Double tapping a bit on each of them. Climate, of course, will cut and encompass anything and everything that makes the planet green and blue and better there. In terms of inclusion, we look at businesses that are either led by the diversity groups or businesses that are empowering the diversity groups, where diversity will encompass gender, sexuality, disability, age, and other marginalized. Bharat, anything that helps strengthen the overall founding country, which will cut across again agriculture to rural India to space, defense, and others.
So the fund is going to adhere to ESG principles and really support startups, I understand, in the pre-Series A and Series A funding stages. Is that it?
With regard to what we look for in a company, we look for the right investors who are there. Given it's a debt fund, the most important and a critical element is the ability of the company to honor and repay debt. We believe in delivering this via partnerships. What we are doing is getting into a partnership with the leading Indian private sector bank, which will enable us to create capital deepening for the startups, get them ready for bank credit, which is eventually the most evolved form of capital. It will cut across various elements. As I said, it will get the founder ready from a balance sheet perspective to have a bank on its cap table. And besides having the right institutional investors and the ability for the company to pay, we want to get a company ready in terms of adhering principles of debt management. I always say that debt is that pill. It can solve for your problem, but if consumed extra, it can become poison. So it's important for us to come help the founders optimize their capital cost, have the right capital structures in place.
So what is the typical investment size for this fund?
On an average, we look to deploy anywhere between 2.5 to 4 million, which, given it's a 3-year commitment period, we look to turn capital minimum 2 times. That will enable us to underwrite 50 unique companies during the fund's tenure. These companies, as I said, will cut across their life stages, but we'll see a good chunk coming from early companies.
Now, there was also plans to expedite the transition, and there's a goal as well for the firm company to expedite the transition to net zero building. How is that coming along?
We have entered into a partnership with a bank. We are trying to enter into similar partnerships with our other stakeholders. What that will enable us is to have right markers on the ESG journey for these startups. You will see us adding a new dimension into this, which is culture. We believe that while the country is thriving with great startups, we want to see extremely responsible startups to be there. And for that, this framework that we are building in collaboration with other stakeholders is going to help our founder and the team clearly mark out how they are progressing around each of these spaces, positioning us as their partners than mere transactors. Because eventually, we see them growing from venture debt to bank to eventually the most evolved form of capital. We call it responsible capital, which is in the form of developmental financial institutions, sovereigns, endowments, and pension.
And how do you really plan to co-build with your founders? What's the game plan?
Absolutely. So I have a partner and a friend, Siba Panda. Siba and I met professionally around four years back when he was with the leading venture debt fund in the country. While our original conversation started on the gaps in the startup ecosystem and how a banker and a fund manager would come together to deliver this, eventually we find our common aspirations where we wanted to blend profitability with purpose. And that's how we found our soul and ValuAble. Eventually, as this platform unfolds, we will see many more stakeholders to come in. I believe in building institutions. I've seen that the power of that in my previous avatar as a banker. And multiple men will collaborate. We are sure that we are collectively there to deliver greater good.
So there was also a plan in place to make roughly 50 investments within a 3-year time frame. Do you think that you'll be on track? And what is the outlook in terms of what really makes the cut for the startups in terms of scalability, sustainability as a criteria as well as returns?
Absolutely, that's the ballpark number. We might end up seeing these 50 unique transactions depending on how fast we are able to churn capital. But we believe that's an optimal number which which the fund may be able to see.
Thanks so much for giving us an insight as to what ValuAble is all about. Let's move right on then.